Hey, welcome back to Everything Money. We're glad you joined us today. We have an incredible guest. This is Jerry Parker, founder and president of Chesapeake Capital. He was one of the original turtle traders documented in this wonderful book, The Complete Turtle Trader. Jerry, we welcome you into Everything Money. Thanks for joining us.
Oh, thanks very much. I'm glad to be here, and I'm very relaxed. So thank you for that.
The Complete Turtle Trader is a book written by Michael Covel. He caught wind of Richard Dennis in 1983, who hired a bunch of new traders. He gave each of them $1 million, and they amassed around $150 million over the next 4 years. And Jerry happened to be one of the best traders. So we've been talking about this book for a long time. Paul reached out and got this all hooked up. And so, Jerry, we're very honored to have you on the show. Our listeners want to learn the thought process of how you got to the state, what you did back in the 80s, what you're doing now. We have tons of questions. So we'll get after it. Paul, go ahead, and Mo, they're going to have a majority of the questions. I'll lead into, Jerry. Thank you again for being on here, and we'll get cooking. Paul, get after it because I know you're dying to.
So our viewers all know, by the way, this will be the first interview we post after hitting 100,000 subscribers. So Jerry is entering the world famous Everything Money. Everybody who watches the channel realizes how much I love process. Like, to me, the reason the Complete Turtle Trader made sense to me, it was just follow these rules. And Jerry's considered the most successful turtle trader, not just because he had a $2 billion fund at one point, but his obsession with the rules. So Jerry, when we spoke in our first call 2 weeks ago, you talked about how trend following and momentum trading was already appealing to you before you saw the Richard Dennis posting. So can you talk a little bit about that? You were an accountant, and that always made sense to you. And then we'll get into how you found Richard Dennis.
Okay, thanks. Yeah, I read a little bit about trend following and was able to watch people on TV and read newsletters. And these guys were doing some trend following. And I thought this objective approach with rules and holding on to winning trades as long as you could and getting rid of losses fairly quickly was a great idea. And it was objective. The whole point is we can figure it out. Are the big winners going to pay for the small losses? And so that really appealed to me. And then, trend following, even back then in the 80s, it was sort of associated with trading a lot of markets, which meant futures, currencies, commodities. I was like, sure, I can see more diversification. I did not have a closed mind. I didn't know anything about trading, but I was like, that makes sense. More diversification. And then short trades, sure, I could see that as well. Profit if the market goes down. And then I sort of learned that that's another form of diversification as well. So for some reason, we spent a lot of time on podcasts and then talking to clients and potential clients, trying to choose these magic words to convince them that trend following is so amazing and it's a decent investment. And yet immediately when I was in my mid-20s, I need no convincing at all. It just, I thought it was great. And it, the whole idea of this objectivity versus subjective and the rules-based, you could do a back test. It just suited my personality.
Yeah. So it's funny. We talk about, this channel is called Everything Money because I'm a value investor, Mo's a value investor, but I always tell people there are multiple ways to skin a cat. And the Paul of 15 years ago would have said, nope, value investing is the only way to go. And as time got on, I sat there and said, well, no, there's other ways to make money. Like Mo does a lot of chart reading. I loved momentum trading for exactly what you said. It's completely objective. Here are the rules, stick to it. Now, I love value investing, but the one criticism I have of value investing is it's subjective. It's the art of investing. It's like, well, one person can look at, I remember years ago, a value investor telling me Amazon was a buy. And I remember thinking to myself, like, how are you getting Amazon as a buy as a value investor? And sure enough, they end up looking right. Now, whether they're right or wrong, I don't know. But at 350, they said it was a value play. And I thought it was worth 100, 150. And now I think it's worth 1,000 and it's at 3,500. So there's there's a lot of subjectivity in value investing. And momentum trading spoke to me. And trend following spoke to me for the exact reason for you, Jerry. It's just, here are the rules, stick to it. And once you start bringing your subjectivity into it, that's when things start to fall. And I assume you agree with that because, my assumption about your fund is it's driven by computers and it's done automatically. But back in the 80s, when you guys did it, you had to manually put in these entries and call the floor and say, hey, here's my purchase, here's my exit if it hits this price, et cetera, right? I assume that's the way it went back in the 80s.
That's right. I mean, the trades are they look similar now, but they're done differently. And we have all these fast computers, and we can do more back testing, which can get you in kind of trouble as well, trying to massage that data and torture that data, as they say. But following prices and is what we do. Following the prices only, we try to tune out the fundamentals. And at the essence, at the heart of it all, is you can't predict where these markets are going. It may be totally legitimate that it's overvalued, or that your value ideas are still legitimate, but
who cares?
Yeah, who cares? And you make all this money. Maybe the only profit I actually make is people who overshoot it, and they buy when they shouldn't, and it was sort of all illegitimate, way above value, and then it reverts back eventually. But who cares? Who knows? You can't predict. We've seen so many things. We're reminded all the time, especially recently, of things that happened that we never could have predicted: Bitcoin, Trump, COVID, that are really going to matter and are really going to be great profit opportunities.
Yeah, Jerry, I had a question. I brought up the idea. I've heard on other shows, in this era of constant communication where info sharing is happening on a second by second basis, how has your mind shifted over these decades from maybe finding these trades or finding companies people don't know about? It seems like there's not a lot of secrets anymore. So how have you adapted to this, and how can maybe new traders learn your ways?
Well, it's shocking how little I have evolved or adapted or changed. I've done a lot of research, and I've been in business and thinking about these markets for over 35 years. So you would think I would have come up with some better ideas, but we had great training and great teachers and genius mentors. So I started at the top, but definitely the biggest change by far is just the need to be longer term. These trends still happen. People are still surprised. People still like to go against the trend and be smarter than the market and call the highs and call the lows. They can't resist. Everyone knows these obvious trades, but then they turn out not to be very obvious. But the trends are choppier, and so there's plenty of opportunities to get whipsawed out of a position. And so we use stop losses. We've had to increase the stop loss so we don't get bounced out so quickly. And then as the trend, something like Bitcoin or Tesla, as you can look at those charts, as they go up, they can be very choppy. And then all of a sudden you get bounced out and it goes right back to the highs. And so you need to walk that fine line of not getting bounced out on the way to a big trend, but then in the end, not giving back too much profit. So that's really my job, is to figure out a way to stay in, but don't stay in too long. And something like Bitcoin and Tesla are just the perfect trades to judge your approach, because they're big money trades. They're the big outliers. That's what we play for. And so how you handle those really says a lot about your system.
So Jerry, when we had our pre-call, we asked you, does what is in the complete TurtleTrader, do those rules still work? And you emphatically said, yes, they do. You also said that you've done back testing and you've kind of changed over time. Paul and I were talking about this. What made you make that change, and how often do you change? And why are there better rules that work or better systems that work compared to the rules that happened back then?
And let me interject. So as an example, what Mo's talking about is the book talks about 20-day breakouts and 55-day breakouts. It talks about 2% positions, and I think later it was altered to 1% positions. But Jerry, in our call, you said, hey, I focus on 100 or 200-day breakouts, and I do 0.25% positions in 125 different stocks and futures. So, you talk about getting back testing gets you in trouble, which we do agree with. So how did you balance all that, and what caused you to go, wait a second, this might be, because I prefer, when you said 100 or 200, I was like, oh, that's wonderful. Yeah. I prefer the longer trends. Like, I'd rather just sit there and wait for a longer trend, be more patient, trade more markets, and just wait for things to go out. So tell us about, that's what Mo's asking, is tell us about that whole, how did you come upon these? And then what made you say, there might be a better way? Was it just your testing methods, et cetera?
Yeah, well, basically, what happened in the late 90s is the shorter term stuff, something less than 100-day breakouts or 200-day moving averages, it stopped working. And then we did a back test and we showed that the longer term stuff works better. It's continuing to work and it's always worked better. So even when I was trading shorter term from the Turtle program, the longer term stuff worked. And by our analysis, it worked better.
Hmm.
I'm famous for saying one entry, one exit, and a stop loss. So you have one rule to get in, crosses over the moving average, and then you have one rule to get out, crosses below the moving average, and then you have a stop loss. And so that is a very robust and reliable approach that yields a back test with a large sample size, which is the most important thing to concern yourself with. So there you go. I said it. Everyone glosses over it. I'm not going to say it again because no one pays attention to it, but it's this trade sample size. And then the problem is, then the result is you make a lot of money. If you're if you're medium, if you're in this 100 to 200-day breakout range, okay? However, there's got to be a downside, and there is, and that is it's volatile. But you're having this volatility with the big profitable trades. So you're transferring the risk from the losing trades because you're taking small losses, like you said, 25 basis points per trade, 120 markets. You're transferring the risk to when you make money. So in a big trade like Tesla, Moderna, Bitcoin, you put the trade on a year ago and it goes straight up and you automatically start making money. So it really doesn't even, the capital you're willing to risk, you didn't lose. So the volatility comes with a massive open profit. So I think that's a pretty good trade-off, right? We do take a lot of losses. 60% of the trades are losing trades.
Repeat that, Jerry.
Yeah, say that.
Repeat that, because I want everybody to hear this, because everybody has such recency bias of looking at, oh, this trade didn't work, therefore the process doesn't work.
Correct.
60%.
Right. 60% losing trades, but they're small. And one of the things that's happened over the past 10 years is that we had a lot of losing trades in commodities, but we're committed to diversification. We are undaunted in not getting rid of those commodities or reducing our commitment to the commodities. We do understand that other people who don't trade commodities and who trade stocks, that's better and has been better, and diversification has been punished. But we stuck with it, and now we're getting these big rewards for this massive commodity move we've seen in the past year.
So I guess, you said, we talked about, we asked you, does turtle trading still work? Emphatically, yes. But then late 90s, you said shorter term breakouts stopped working. So how did you sit there and say, was it just you saying, well, let's go look at a back test and see how the longer term stuff does? And like, oh, it works even better. Let me stick with that. Because I think the longer term stuff works just intuitively, thinking most people are impatient. They're going to get emotional when something goes the wrong way, but they're still in it. And they're therefore going to probably bail on it. And then that's why it works more. Is that kind of the idea behind it? Or is that why you think the longer term stuff tends to work better? Because let's be honest, Jerry, I told you this example. The reason complete TurtleTrader worked for me and turtle trading worked is I remember being at the casino and I'd literally follow basic strategy at the blackjack table like a Bible, and everybody around me would be like, well, I just saw a bunch of tens and I just saw this. Oh, it's going to be this. It's like, well, no, what does basic strategy say to do? And that's how I knew. So, expand on that, because I look at it going, to me, the longer term trade stuff works because most people will bail on it because it won't work immediately.
I think one of the reasons it works is because the volatility in the open profit trades are just too tough to take. So you can educate people and say, hey, let's concentrate on fewer losses. Let's concentrate on chipping away at our capital. So if we can get that win rate to 42%, that might be good. If we can figure out an optimal strategy for the small loss. But if it's a big profit, let it go. It's free. Let your profit run. I know it's going to be volatile, but that Tesla trade, it made a fair amount of money in the first couple of months. It gave it all back. It never became a loss. And then it just skyrocketed. And you got to play for these big outliers. But as much as you try to convince people of that, it's almost impossible. They just refuse to go with it because it's just so painful. Even if it is an open profit, they can't segregate that in their mind, losing trades and winning trades. And that's really the key to making money. The old cliche of letting your profits run and taking small losses. Nothing could be truer.
Yeah.
I think the small loss part is easy. People can do that. I want to get out. Much easier than letting the profits run. So that is what I find to be where the rubber meets the road. What separates the winners from the losers? But back to your question, what happened is I just would put up a weekly chart. And I noticed in these weekly charts that these big monster trends that would last for a year or two just popped out. I'd never even noticed them. I'm not big on looking at charts because I think you can get some inspiration, but you've got to do the back test. And our eye is not as good as that computer. The computer is so brutal. It goes back and looks at this idea that we have that we think for sure it must work. But then the computer comes back and says, not so much. But it did inspire me to sort of say, hey, it looks like we're way too short term. We're getting these smallish trends that last a few months. But some of these trends can last for years, and just the mega profits in these outlier trades. Once again, the outlier trades, hunting those outliers, and it's going to be maybe 5% of your trades. I think this is another reason that trend following works, is because to have this as your main strategy. We can't predict. We don't know when they're going to come. We're totally passive. We're going to let the thing be very volatile and give back a large part of that profit, hopefully that it rebounds and goes back to new highs. And we're going to rely upon our whole profit be determined by such a small percentage of the trades. It's just really counterintuitive for most humans.
So on page 218, it actually shows 1988 to 2006 for Jerry Parker's Chesapeake Capital, month by month returns with annual total returns. Have you seen this, Jerry? I assume
No.
It's accurate. Well, it shows your return. So it shows from 88 to 2006. Guys, in those 19 years, there is only 1 year of loss. Just one. And it was 2001, you had a loss of 8%. Other than that, the highest was 61.8%. And the lowest was 1.8%. By the way, FYI, the 1.8% was the year before the 61.8%. So to me, guys, and this is what I love about value investing. And it's funny because I watched this. It's about managing your downside risk. So that's what they have the stop losses in for. It's about saying, okay, this thing hit this breakout. We're in. The stop loss is put in place because as an exit point, and you're not going to get the high, you're not going to get the low. And if it starts to go lower, you exit, you move on. But the interesting part is, guys, if you have the book, open it up. The number of months that he has losses in is insane. So he has 1 year of losses in 19 years, but in month-to-month basis, and the first 4 months of 1988, you had losses, and you still ended up the year high up 50%. And you had losses you had 2%, 2%, 7%, and 10% loss in those first 4 months of the year. So the average person would have given up saying, this doesn't work, this sucks, I'm out.
You know, Jerry, I listened to an interview that you did, and I remember you saying, when they started making me report month to month, I was like, what are we doing here? I can't, because I'm looking at the long term and saying, I can't report month to month. It's going to look terrible for everybody, or it's going to look really good for everybody. And it's just totally irrational to report this kind of trading on a month to month basis.
Yeah, we never were told anything about monthly trading in the Turtle program. I never heard about Sharp. So I was an accountant, so I was completely capable of doing my performance table in February of 1988. But the 1988 was the grain move, the drought in the Midwest. And so all of those losses were wiped away by those big trends. And that's kind of what happens. But you don't get positive feedback from clients or non-trend followers. It's always, if you could just get rid of those bad periods and keep the good periods.
That's so simple.
So,
Why don't you do it?
Yeah, it's so easy.
yeah, as if we don't understand and we don't really think the same thing.
Right.
But Richard Dennis and Bill Eckhart were these genius people, way ahead of their time, and the systems that they created and that turtle experience is still way ahead of the times, because what has happened over the years has been just a wave of really smart people getting involved and understanding and figuring out the benefits of this diversification, longs and shorts, momentum and trend. And they've just polluted their systems and the thinking with lots of other things other than one entry, one exit, and a stop loss. And it's really a shame that sort of this classic trend following that I've been describing is practiced by so few people, because anything like sharp or volatility based measurements, it goes against letting your profits run. And you bring up a very good point. I've got a million points in my head, which not all of them I can remember. But the point you made about the number of losing years, that just popped out at us. And we're saying, like, it's going to be volatile. It's going to be a lot of losses. We're still waiting for 5% of the trades to make all of our money. But man, we've never seen a losing year in this back test. And you're like, holy smokes, is that a good trade-off? And we were like, hell yeah. It's the trailing 12-month return might be more robust, because any 12-month annual period, you could get lucky. And we obviously got lucky with a 1%. It could have been -1 or 2. But my friend ran a back test the other day with similar systems, and he had no losing years since 1977, which is not to say that that can be repeated in real life. It's just that, to a lot of normal people who don't, you almost have to be overly educated to figure out a way that having a 90-some% of your trailing 12 months be positive is not good enough, and we should use another metric, something like Sharp or even max drawdown, because once again, max drawdown is going to be dominated by periods where you're tremendously profitable. So if I have a 20% drawdown, but I'm up 20% for the year, that is something that the traditional measurements are going to miss.
Right. Jerry, how do you, I get this question a lot because I do a lot of chart reading, and I often say, I heard you say yesterday, you really buy high and sell higher. And I always say buy high, sell higher. And that's very counterintuitive to people. It's the emotion of it. I get this question all the time, and maybe you can answer it in your own way. How do you control emotion of saying you're going to buy high, sell high, you're going to go with the trends, you're going to be able to stomach this volatility, et cetera?
Follow system.
Oh, well, of course so it is follow the system, but how do you get yourself to believe in the system?
A couple of ways. One is, thankfully, I've never been rewarded for breaking the system. Sometimes you might get rewarded.
Excellent point.
You will make out, like if you get out of your positions quickly, that actually worked for you. And thankfully, it's never worked for me. So I have nothing to lean on except failure. But I don't find buying breakouts to get into a trade difficult. Once again, taking small losses.
Right.
What is really difficult, like is right now, is when the markets are so darn good, and you just hold on to these positions, and you're making so much money so quickly. Everyone is just thinking, darn, I really don't want to give this money back.
Exactly.
So,
and that's when you don't let the trend run for you and let your profits run.
Exactly.
Yeah.
Because it's really, we're all humans. It's so difficult. You're going to get pressure from your family and your clients. And it's competitive, because there are many traders who trade trend, but get out too quickly. They violate the system, and then they kick your ass in a certain month.
Yep.
They're up 5, you're down 5. And you're like, darn. And so the competitive nature and not wanting to lose, it can sometimes outstrip your concern over even losing the money.
Right.
Jerry, I think we have so many questions, but one's hitting me. I represent sort of the normal guy on the show. So, There are a lot of young, new investors and traders. I don't know if you've ever opened up this app called TikTok, but they're downright telling young people to invest your first 1,000, then borrow another 1,000 against it. Very short-term options that are expiring in less than a day. Where do you see all this going with this massive influx of young people? I'm guessing they're not gonna stick to a lot of these rules, and especially if they're doing it sort of a I don't know, listening to old fuds like us, like where do you see all this going with new traders entering the market?
Oh, I definitely think that new people can embrace trend following, just like I did. And I think there's this cliche or joke out there that the only way that things change is when the old people die off. So I think we're into a lot of. I have to deal with people all the time who are not into trend following and don't like it, but I think the new generation will like it. But part of the principles of trend following or proper money management is to place survival at the core. So whatever you do with investing, especially trend following, it needs to be your most important thing is to live to trade another day. So trading small is very important
Mm-hmm.
and not using a lot of leverage, risking 25 basis points of your capital per trade, trading as many markets as possible, long and short, currencies, commodities, stocks, bonds, crypto, not having a concentrated portfolio.
Right.
These are the things I think young people need to absorb. You can't predict where the markets are going. But I do hear way too many people talking about why don't you create a fund that only trades Bitcoin and crypto trend following? Like, no,
Yeah.
um, you. That's a great addition. I trade Bitcoin futures. It's not correlated to anything else. So, boom, I love it. It's in my portfolio. It's liquid. It's safe. I can take a small loss. I don't really care what the market is or what the name of it is, as long as it's liquid and exchange traded. Um, and it's especially if it's uncorrelated to traditional markets. But as Richard Dennis said, trade small. You're as bad today as you're ever going to be. So you need to always, and that's been my biggest problem. Married with not following your system, which is the biggest rule, is the second biggest rule, which is don't overtrade, don't risk too much. And as you mentioned earlier, risking 1% or 2% per trade back in the 1980s, we were making 200% a year, but that's not the way to go forward if your bottom line is to survive and not lose all of your capital. We got kind of lucky because I lost 50% in one day once. So that's not the type of strategy you want, and it's not necessary for a good living or to have fun.
Yeah. So one of the main questions I had in this complete TurtleTrader book, and I don't know if I think you're aware that Michael Covel offers, some sort of course about he can help you and all that stuff. But when do you add and when do you remove markets? Like, obviously you see Tesla and Bitcoin. At what point do you go, you know what, I need to be in these markets? Because obviously you're not following every stock. And by the way, everybody, when he says markets, and correct me if I'm wrong, Jerry, if you add Tesla, that's adding a market, not adding a market as in terms of adding the New York Stock Exchange. He's adding individual futures, individual stocks to your 125. When do you know to remove one? When do you know to add one?
I think the goal, theoretically, the goal is to have a diverse universe, 50 to 100 markets or 200, if depending upon your infrastructure and your capital. And theoretically, it would be a fixed universe. So you would trade those markets for the rest of your life. It's okay to add a market or two if it improves the diversification. And it's okay to get rid of a market, but I only get rid of markets if they become less liquid. So, it's people talk about cocoa, and I don't think cocoa's made money in like 5 or 10 years, but I refuse to move it because it will make money one of these days, and it'll become a good market. It'll go at one of these years, it'll have 5 winning years in a row. It'll be the best market for 5 years in a row, possibly. Just like the commodities were bad for 10 years. Now they've totally rehabilitated themselves. They've risen from the dead. The CTAs were the only ones dumb enough to keep trading them because it's inbred into our philosophy that you can't predict these markets, and just because a market has not trended for a while, it probably means it's actually setting up to be a good trending market. So we've eliminated markets when they've gone, when the liquidity has gone away, or the futures market has gone away. But we really just keep adding. If a stock gets taken over, we have to switch. But I like to trade the single stocks versus the indices, and I choose the stocks. Maybe like 25% of my portfolio would be these single stocks, and I choose them just mainly based upon the diversification qualities. Are they correlated to the S&P? If they're not correlated to the S&P, then I'll probably try to add that stock to my portfolio.
At what point are you searching for more markets to add? So if you're at 120 now or 125, when are you going and saying, okay, now I want to go add more for this reason? Is it when you see performance down for a few months in a row, you say I need to do something here? Or what makes you make that decision to go add more?
I'm adding all the time. I'm thinking, and I want to add something, that is going to add diversification. So I trade a lot of grain markets. So I'm maybe not looking for more grains to trade, because it's probably going to be, soybeans in South Africa might be very similar to soybeans in the US. But I'm always reading the news, and there are a lot of new things going on, like lithium, cobalt, uranium. Where can we get exposure? There's not traditional futures markets. So there may be an ETF that has uranium stocks in it. So I'll dig inside that ETF, pull out a few stocks, and say, okay, this looks fairly correlated to uranium. Until we get a uranium futures that's liquid, I'll have to use my ingenuity to figure out ways to grab some diversification, in some of these markets. Like, so but it's a constant thing. We started with 20, it's 130 now, and hopefully it'll be 150 next year. And it'll be this eternal process of keeping the systems relatively simple and robust, but gaining more diversification and stability of the portfolio by finding different markets to add. It's not that I like the volatility. It's not that I'm just saying I'm going to let those profits run, but it would be nice to have 200, 300 markets that were not so correlated, to where I would trade these markets so small that the volatility and the drawdowns in any of these big trades would be almost unnoticeable.
Okay, so that's pretty awesome. So, we talk on the show, and Jerry, you manage money. How much, just really quick, before I go to my next question, how much does Chesapeake currently manage, if you're willing to disclose that?
A little over 100 million.
Okay, so your belief is that, so just like a lot of investors have a hard time understanding this, the bigger you are, the harder it is to make what's called alpha. You know what I mean? It's hard to make that. Mo and I, we don't manage outside money because we don't want to, like you said before, it's hard for investors. Investors look at month-to-month returns. They don't really look at the long term as much as they claim to, et cetera. How much of the 100 million is outside money? I mean, have you ever thought about just saying, well, why should I do this? I should just manage my own capital because that's all I need to do.
A lot of the money is mine, and plus now I have set up a fund with investors, and they don't have the ability to influence me. So that's another big important thing.
That's great.
At 2 billion, I'm heavily influenced, and maybe not as strong as I am now, where I've resigned myself to say, hey, look, for proper trading, you have to have the right clients. If your clients are not willing to let profits run and do the right thing and follow the system and allow for drawdowns, then if you're going to be influenced by that and be sort of stuck with, make the management fees and, and the AUM and the pride involved more of your bottom line than doing the right thing, then you can defeat the whole purpose. So now I trade less money, but I'm having way more fun. The trading is much better. I follow this process. For a CTA trend follower, success every day is, did you follow the process, not whether you made money.
Right.
I wanted to throw that in because you had mentioned process a few times. So I think that's another mentality that people have. Like, don't walk away at the end of the day feeling bad about yourself because you lost money. Walk away at the end of the day feeling bad if you didn't follow your rules, even if you made money. You know, that was one of the Turtle rules.
Oh, yeah.
They told us if you made money by doing the wrong thing, you'll be in trouble. And, you know, to start from day one with that mentality, you're given the rules, you're given the money, and the bottom line is following those rules, and then you'll be okay. You know, that's a pretend situation. It doesn't exist in real life. In real clients, they're telling you, dude, if you have to cheat, if you have to do something you're not supposed to do and make me more money, like right now, I'm fine with it.
You know, it's funny. I'm an avid tennis player, and my tennis coach and I, this is how I knew that trend following and this process was the right thing. I remember we'd hit tennis ball and we'd play points out, and I'd hit a phenomenal shot and it would go out. And I'd say to him, yeah, but I hit a phenomenal shot. It just happened to go out. Or I hit a terrible shot. It would go in. He goes, what are you mad about? It went in. I'm like, well, because I hit the wrong shot and it happened to go in. But in the long run, that's not going to work for me. And that's when now I look back on this going, yep, I was meant to do something like this, because even in something like tennis, I would hit a great shot, hit it exactly the way I wanted to. I put too much power into it and it went out by a little bit. To me, that's a great shot. But one that I hit poorly, happened to hit the top of the net, or did something and fell right in, I'm not taking credit for that one. And that's the thing that we try to instill in our viewers. It's process, process, process. You know, I will have viewers reach out to me and say, Paul, because of you, I'm up blah, blah, blah percent. I'm like, no. Don't thank me for being up over 3 months. Call me in 10 years and say, Paul, I learned a process and I applied that process to all my investments. And because of that, I beat the market by 2% a year. That's when I want to thank you. And I'm assuming that's along the same, not assuming, that's exactly what you're saying here. If you do the right process over time, you will win, because 60% of your trades are going to be losses, but the 40% that work are going to way more than cover that 60% loss.
Exactly. I think it's nice to be wired that way.
It's wonderful.
Yeah, it is.
not to brag on ourselves, but
brag.
You know, whenever I've made a mistake and gotten away from the process and the philosophy that I was taught, I just admitted it. I would just beat myself up, you know, and I would just say, you know, this is really a tough game. There's really no ultimate answer to not have drawdowns, not to give back, you know, some profit in these big trades. And I would advocate on this podcast and other podcasts, you know, the right approach. And then people would assume that I never did anything wrong. I would say, no. I did lots of things wrong, but lots of things. The thing I did wrong was not following the process and not sticking with what I know to be right. I just find it frustrating to listen to people who just try to convince themselves that adding a silly rule the rule is only good for just taking profits and not letting your profits run. Well, you know, it's a rule, and we're rules based. You know, there's good rules and bad rules. So you can convince yourself that by adding rules to your strategy that just help you get out of profits before you should is legitimate. But to me, it's just rules-based discretion, you know. And I think just admit to yourself, I'm weak. I can't do this like I'd like to. I'm going to keep trying to do it, is a much better place to be than trying to convince yourself that adding these silly rules and these rules that really violate the philosophy of trend following are legitimate. Yeah.
Jerry, do you at Chesapeake, do you guys automatically enter does the computer automate the trades, or do you manually enter them?
We log on to the exchange website, you know, through a broker, and we input the trades ourselves.
Oh,
wow.
Okay. So that answers my question. I was going to say, if it's automated, which I thought it was, I assumed it was, I thought that, how do you deviate from the process with that? But now this explains it a lot more.
Well, a good way another good way to handle that, you know, a lot of clients and people prefer the trader, the human being, to sort of do a sanity check versus the computer is putting all these trades in. Maybe we're not that good of programmers and we do a trade we didn't want to do. But I think another way of handling it is to have a division of duties where you have one group that does the back test, creates the systems, and another group, their only job is to do the trades. So I really don't have a way of overriding the traders. I don't see the trades in the morning. They see them, they do them. If all hell starts breaking loose, like February of last year, I'll probably hear about it. And I think another rule that is a great rule for your audience is trade smaller. So we have this one rule that we will use once every 4 or 5 years if we really get into some crazy activity where we're losing lots of money and the markets are going really crazy. Everything's going against us the same day by large amounts. We'll just interject this rule of get rid of 25% of our positions or half of our positions. And this, it takes away the discretion of overriding the system and trying to guess what we should do, which markets should we get out of, which ones we should stay in. And if you have this cutback rule, then it allows you to go right back to just following your system. So trade small is, I think, mostly always a good rule to have. You just don't want to get yourself in a situation where you're implementing this rule like weekly or daily because you obviously have other problems.
Right.
Riding the system by trading smaller is a rule that's going to work every single time to prevent you from losing too much money and help you stay in the game. It just shouldn't be necessary too often.
Right. Two questions. How many traders do you have working for you and executing those trades?
We have 3.
Okay. And the second one, so I listened to an interview that you did in the past, and you were talking about basically what you're talking about now. What percentage movement day to day is too much? I heard you say if it's moving your net worth or your assets invested by 5%, that's too much. Maybe a 0.5% to 100 basis points is more reasonable. Do you have a set number in stone that you don't want to move your portfolio per day?
That's a good question. I mean, I think on almost all the days should be less than 1%, let's
Okay.
say. But once again, you get a hold of some of these outliers and Tesla, Moderna, coffee, Bitcoin, and you're going to see some ups and downs on these big profitable trades. So you're up 20%, then the next day you're up 22. Or the next day you're only up 18. So in my opinion, it really just depends on, are these fluctuations due to profitable trades or are they due to a lot of losses?
Okay.
These small losses can add up and we have to be careful with that. But I think that one should be more tolerant of, the big winning trades are going to have some volatility. So you need to let that go for the most part.
Right. Let them run.
Yeah. But I remember back in the old days, 5, 6, 10% a day. Yeah. That's way too much.
On a consistent basis. Yeah, that's too much.
Yeah. It's too much.
Jerry, as we wrap up here, we're lucky enough to have a great community of followers who are going to go bonkers about this interview and learning from you. What type of people, if they're new, could excel at trading? And what are maybe a couple tips you might give them if they're looking to get into this?
I think I get asked this question a lot, and the question is something along the lines of, I don't have millions of dollars to manage. How do I get this diversification? I feel like the diversification is important. You mentioned it on every other sentence, and I say, yes, you're correct. It is very important. So I believe that the trend following approach that I've described, if that's not enough instruction, it's in the public domain. Covel, the books, the websites, the turtle rules are there. Just be a bit longer term, I would say. So now let's think about the markets. And with fractional ownership of shares in the stock market at some of the brokerage firms, you can buy some stocks. You can try to find stocks that are not that don't look like the S&P, Beyond Meat, Canopy Growth, Peloton, I own these and I'm not making money in them. So they don't look like the S&P, unfortunately for me. Commodity ETFs, currency ETFs, bond ETFs. There's your diversified portfolio with $20,000 or $50,000. Just get out there and try to trade 50 markets and do some shorts as well. Sometimes the shorts, like in February of last year when COVID hit, all the stocks went to one. The correlation was very high. They all went down, but so did the currencies and the commodities, and they crashed as well. So there was no hiding. So I can't overemphasize the necessity to have short trades. If it's in a downtrend, if that breakout is a downside breakout, your goal, you would be happy. You can't really have a goal to have shorts and longs because you have to go with the trend, but you really are not going to be unhappy if you have like 10 longs and 10 shorts. That's a good thing.
Correct.
Yeah.
Yeah. Great answer.
Jerry, is there, as we wrap, I'm thinking, is there anything you'd like to promote? Can people follow you? Where can they find you?
If you have $100 million, do you want them to call you, Jerry, to have you manage their money for them?
Yes.
Well, ChesapeakeCapital.com. I'm on Twitter. I'm easy to find on Twitter. RJ Parker Jr. 09. And then Clubhouse. I have a weekly Clubhouse trend following trading club. I'm easy to find on Clubhouse. And that's really fun. I meet a lot of people. And I like investors who are high net worth and who can listen to this and say, oh, yeah, that makes perfect sense. And that's the type of investors I have. And that's
what's your minimum?
Yeah, what's your minimum?
The minimum is like low. It's $100,000 in the LP. And we have a mutual fund as well. So the minimum is very low there. The Chesapeake Mutual Fund is out there for the average investor. So that's a great way to access classic trend following with all these fun different markets. One of these days, it's going to be, people are going to have to agree with me that stocks do not have superior trends. They're not superior in any way. They're great. I love them. I'm one of the few CTAs who totally embraces single stocks versus indices.
Mm-hmm.
You'll get these big, huge outliers in the single stocks better than the indices. So I love stocks, but commodities, currencies, and bonds as well.
Yeah, that's perfectly said.
Jerry, thanks so much.
Yeah, Jerry, this has been incredible. We'd love to have you on in the future. Like I said, we have a community that's going to love this. And if you're out there watching and you haven't read this book, go grab it, learn more about Jerry. He's on YouTube as well. And yeah, Jerry, thanks so much for joining us. And we can't wait to have you on again. Appreciate it.
Thanks for having me, and congratulations on all these 100,000 viewers. I'm really happy for you guys.
Yep.
Thank you very much.
Jerry. All right, talk to you soon. Thanks, Jerry.
Thanks.